Here to discuss creative capital and impact investing to power inclusive growth, please welcome Jean Case, CEO of the Case Foundation, in conversation with New York Times columnist David Leonhardt.
Good morning, everyone. Thanks for being here. So we're here to talk about impact investing and obviously how it connects to inclusive growth. Jean's one of the leaders globally in impact investing. And so just to set the scene very, very briefly, we clearly have a problem with inclusive growth, right? In this country and in much of the world. That's why we're here talking today about how to solve it. So in the United States, net worth for the typical family is lower than it was when the century started. Income growth has been extremely slow for most of the population. The statistics that I find most alarming are the fact that life expectancy has been stagnating for most of the population. And so can you just start by giving us sort of a sense of the landscape in impact investing, what it's doing, and how it's taking on these problems?
Sure, and I'll go, by the way, good morning, everyone. It's a real delight to be with you. I'll go quickly through a landscape here. So when we talk about impact investing, it's definitely a burgeoning sector or field. In 2018, assets under management were about $502 billion, so $500 billion. That's not large compared to the global economy, but actually assets under management have been doubling every year in recent years. So if that stays on track, of course, we might be looking at $1 trillion under management this year. That is larger, even at $500 billion, that is larger than the GDP of many, many countries in this world. So it's relevant and it's significant and we should be paying attention to it. Alongside that, so that is really, when we talk about impact investing, we're talking about companies or funds that provide both a financial and a social return. But there's another set of dynamics in the landscape that I think is really worth focusing on today as we think about inclusivity, and that is on the inclusive capitalism front, we're falling down. Last year in America, 79% of venture capital, which is really the jet fuel to grow young firms, went to just 3 places: New York, Massachusetts, and California. California alone got over 50% of venture capital, and our third largest state, Florida, got less than 2% of venture capital. It's much more dire for women and for founders of color. For women last year, only 2% of venture capital went to women-led firms, less than 1% to firms with an African-American founder. Now, why should we care about this? Because as we come together today, we know America is not, all that, but we are sitting in America. Most people have looked at the American economy and the American dream as really kind of iconic. And it turns out that all new net jobs in the United States are created by new firms. While we celebrate our big firms and they have a very relevant and important point in our economy, it's actually new firms that spur jobs. And we're at a 30-year low in new firms. So we really need all the ideas and all the players on the field, and we have to somehow come together to move capital toward them.
Yeah, there's been this fear in some quarters in recent years that our problem is layoffs. But as I read the data, it's the flip, right? It's not that our economy is too dynamic, it's that our economy is not dynamic enough.
That's right, and this spurring of new, and if you think about it, many of you follow the term FANGs, which of course is all the new tech companies for the most part, only decades old. If we don't continue to regenerate new big firms, we're just not going to see the same vibrant economy. But more importantly, I see it as almost an innovation imperative, because at the end of the day, what entrepreneurs do is they solve problems. And they tend to solve problems they've lived or lived close to. So you might imagine that the kind of innovations a woman would come up with, someone from Africa might come up with, a person of color living here or somewhere else might. They're going to be different innovations than the elites on the coast can even imagine or develop in many cases.
So the central theory of impact investing is that the market has failed in some way, right? That there are profit-making opportunities among people in the middle of the country, among female entrepreneurs, among entrepreneurs of color, among entrepreneurs in other countries, that the market isn't getting to on its own.
Yeah, I actually might paint it in just a bit of a more opportunistic sort of tone. I often teach MBA students, and when I was teaching at the School of Management at Yale, this young kid raised his hand and he said, I just could never understand why your generation only wanted a financial return from capital when it can do so much more. And you know what? He's prescient. That's exactly right. We haven't asked enough of capital. We can ask more. And there are companies being born every day that are growing and pointing the way. I'll give you a great example of one that most of you know, Warby Parker. You know, Warby Parker, there you go. Not only like the hottest brands in terms of eyeglass, you know, blew past unicorn status, but more importantly, because one of their founders had worked for a nonprofit in Africa that provided eyeglasses to people who otherwise couldn't have afforded them, he really had sort of a passion for blending that into the model right from the start. And as I think all of you know, because I see shaking heads, especially those of you in glasses, Warby's model is buy a pair, give a pair. Why does that matter? So you have this super hot company that everybody is watching that has established both its brand and sort of its, you know, it's a rocket ship. But in the meanwhile, you know, last time I checked, 5 million people received pairs of glasses simply because that impact company said, you know what, we can do more with capital than just provide profits to our shareholders.
It seems a lot of this is cultural, meaning for decades in this country, we did have a culture where companies and capital cared about more than
Totally,
return,
that is
right?
sort of the history, yes.
And now we've gotten away from it. But it seems hard once we've gotten away from it to get back to that old culture. I'd be interested in your thoughts about how we do that.
Yeah, well, I think we have to debunk a bunch of myths because, you know, I know we have a friendly audience here and some of this data has already come out this morning. But the bottom line is companies that are, you know, scoring well on ESG, for instance, are outperforming. Diverse teams at companies outperform their cohorts that are less diverse. Women-led firms are more profitable than male-led firms. So the data is all around us. And usually when people are involved in capital and investments, they're living with the data. But for some reason, in this particular space, the very same companies, McKinsey, BCG, Deloitte, that these companies or firms will hire to inform them, are stiff-arming the data that's staring us in the face about going forward. But I do want to say, look, it's hard to see momentum when it's happening incrementally. But if you were to sew up all the various moves that we've seen in the last few years, this train has left the station. And I know earlier, you know, the Business Roundtable and the restatement of really the purpose of a company came up. I'm sad that that happened in August because I think it didn't get quite the attention that it might otherwise have. That is a huge deal to go back to a recognition that the real role of companies is to serve multi-stakeholders. And more of the CEOs and more of the leading fund managers in this world are saying, we're going to do that. Yeah, it's social justice, but it's much more than that. It is absolutely the best way to run a company and deliver profits in the long run.
I think there's some skepticism out there about whether that kind of change in language is going to lead to change in behavior. I mean, as I said before, to me, culture is vital, right? And so the change in language in and of itself matters. But what would you say to someone who says, yeah, I see that they've said that, someone who was paying attention in August,
right,
and says, I see that they said that, but I assume that's just because they're worried about what President Trump's going to do, or they're worried about Elizabeth Warren, and I'm not sure they're actually going to change anything.
Right, well, you know, this has come up really in a lot of different social issues we've been engaged in because we partner so closely with the corporate sector and have since our founding at the Case Foundation. And sometimes I'm not sure I care about intention if intention brings action. I mean, if the words bring action. Obviously, we'd love for everyone to feel it in their hearts, but if their companies are better actors in the long run, that's a gain. But what I really believe is going to blow this out is the overwhelming, compelling data that says these are better, more innovative, and more profitable companies that recognize that they serve multiple stakeholders. And often those same companies, as Larry Fink has talked about time and time again, take a longer-term view, not just worried about this quarter's profits.
I'd be interested in your sense of why some of these firms that you mentioned are stiff-arming the data. What are they afraid of, do you think?
You know, I think you said, you know, culture is a powerful thing. We say culture eats strategy for breakfast, right? Look, I think they're kind of stuck in their ways, and it's going to take almost like a 2x4 routinely to get them to a new place. But ultimately, why I believe companies really are buying into this is because of demographic shifts. You know, these CEOs, whether they're in this room or out in the world, recognize that the name of the game to have an outperforming company is talent. And to attract and retain the best-in-class talent these days, largely coming out of the millennial workforce, which I want to remind many of you, if you don't know, the oldest millennial is starting to stare at 40, so they're not the college kids.
No, that's right.
They're not one big monolith out there. They have economic power, they have consumer power, and they're not afraid to use that. But the other power they really have is to decide what company to go to work for. And you talk to any Fortune CEO, and they will acknowledge this is an issue. And it's part of the reason, even if they're not coming at it sort of natively into this idea of having more than one purpose, they know they have to go there because to attract and retain customers and to attract and retain a consumer base, which is between women and millennials, very conscious and will make choices based on what they see that will drive them to action.
Can you talk for a minute about, more specifically about impact investing? What's the early evidence on returns, either in a macro sense or with your experience?
Yeah, well, there has been some data that has come out. Different firms like schools like Wharton or Duke, et cetera, are trying to track what they're seeing in terms of returns. And particularly in private equity, we're seeing that in some cases where there is impact intention, there's outperformance in that as well. For me personally, I have a portfolio that I've had since my AOL days, so it's quite old now, and I hadn't really been paying close attention because I have advisors that help me to where it had gone. So a few years back, I decided I'm going to turn it into 100% impact across all asset classes. And I've seen firsthand the power of intentionality across asset classes to deliver better returns. We put something out from the Case Foundation called the Impact Investing Network Map. And the reason we did it is because there continued to be questions around how big is the market, who's in it, what are the players. And we have tracked over 3,000 investors and $13 billion in assets. We're out there just asking everyone, please bring us your data. But I think there's still so much more needed before we really will hit mainstream. Some things like more data, very clear measurement, particularly on the impact side. It's easy to get measurement of a financial return. A little murkier still when you get into what the social returns are. And we don't have a complete ecosystem. We don't have analysts or the kind of things that are rating systems that any investor is used to when they're considering an investment. So we have a ways to go, but as I said, I really believe the train has left the station and it is definitely moving forward.
And what does impact investing mean to you? I know it's not just about you want to avoid companies doing bad things, right? It's a positive vision. How do you define it?
Yeah, well, many people would say, it's values-aligned investing, but for me specifically, there are sort of two different ways that I look at it. One is, as I said earlier, funds or companies that provide both a financial and a social return, but that's not good enough by itself. In my opinion, there have to be three things present, and this was agreed upon as part of an alliance. Raj Shah's on it with us, but a long time ago, we did some work for the G7. There was an impact investing task force, and at that time, a great group of pioneers coming together around impact investing said three things need to be present: intentionality, measurement, and transparency. You have to be transparent about what are you trying to do with your impact. You have to commit to measure it, and then you have to be transparent with the measurement that's being seen. And frankly, as an investor, when there isn't transparency around the measurement of impact, I don't stay in. And I think this new generation of entrepreneurs and this new class of investors represent a significant part of the market today, but a really overwhelming piece of the market in the days ahead with the wealth transfer and the growing economic power of millennials and women.
And I assume part of when you're looking for transparency and measurement, part of it is how these companies pay their own employees.
Yeah, it's everything. It's funny because when I made this decision to move my portfolio, I needed to hire new advisors because my old advisors just weren't bringing to me impact opportunities. So then we had to decide where I was going to house my assets. And, they came forward with a couple of ideas about a couple of banks. And I said, okay, what's the ESG of the banks? And, one of the banks that was making a strong case for it literally did not have a woman on the board. So, I mean, these are things, we have this saying in impact investing that all investing has impact. The question is, what impact does it have? You are having impact today. What is that impact, and do you understand it in terms of where you're putting your dollars to work?
The Warby Parker story is so nice because it gives people something to kind of focus on.
Yeah.
Can we close with one or two more of the kind of stories that you like of either a firm that you're investing in or that you've seen out there that's doing it right?
Well, David, you and I talked about this ahead of today. Africa was brought up earlier, and a couple of years ago, I took our senior team from the Case Foundation across Africa, looking at the entrepreneurial ecosystem that is very much alive and very vibrant in Africa. And I came back and wrote a blog that said, Africa is open for business. And it really is. I was quite blown away by both the innovation we saw, but also how many of those young Africans had actually had the opportunity to be educated here in the United States and made the decision to go back and use their time and talent to grow great companies there. So one of them I love is called Hello Tractor. And some of you may know Hello Tractor. But in Africa, of course, they're smallhold farmers. And when you think about farming equipment, you think about that at large scale. So when you can actually use equipment instead of just manual labor for your farm, of course, your costs are going to be lower, your yields are going to be better, et cetera. So they created this small form tractor. They named the company Hello Tractor. And the cool thing about it, it's kind of like Uber for agriculture, because Mary can use the tractor for 3 hours on Monday, and Joseph can use the tractor all day Thursday because he's got a little bit more. And what we're already seeing through that deployment of that company is yields increasing. 1 hectare is turning into 2 hectares, turning into 10 hectares. It's a really, really great story. But that, to me, is a really great example of innovations that we see for Africa coming from Africans. And it goes back to what I said earlier about, at the end of the day, the best innovations we've ever seen in this country or around the world come from people who've lived a challenge or see an opportunity very much in a personal way, and build companies to address that. And we're seeing that across Africa, and it's very, very exciting. We left investments behind in a number of different places that we went around Africa, and I think it's another sign of sort of where we're going in the future.
So just remind us in closing, you said $500 billion under management at the end of last year.
2018. Mm-hmm.
And so you're hopeful that we get to $1 trillion relatively soon.
I would expect $1 trillion only because if you've been following, marquee names have jumped into impact investing, and we hope that's all with good intention and clear measurement. But the kind of assets they're bringing to the table that under their management are pretty significant. So if we've already seen a doubling in the early days, I would expect we'll be somewhere near $1 trillion, if not really topping it, but we won't know until sometime in 2020. But I mean, the bottom line is, that kid and what he said to me from, the Yale School of Management, we have a generation who just sees capital as a powerful tool for change. Not stuck in the silos, the old thinking, the box of what a company is, what capital needs to be, wants to mix it up. You heard Raj say the Rockefeller Foundation partnered with Mastercard. I mean, these are the solutions going forward. The scale of the problem, as Ajay said earlier, is so big. We need everybody in this, and impact investing will play an important role, but we need all the players.
Jean Case, thank you very much.
Thanks, David. Thank you all.